Hi everyone, Stephen Lee here. In this video, I'm going to go over the top 5 things all business owners need to know before 2020, including 3 ways to lower your taxable income for 2020. So let's get started. All right, number 1, PPP loans. If you're a business owner and you received a PPP loan in 2020 and you plan to have that loan forgiven either this year or next year because you used at least 60% for payroll, 40% for eligible non-payroll expenses, then you need to make a tax adjustment for the 2020 year. Okay, what that tax adjustment is basically, and we went over this in my previous video in regards to how the IRS actually provided guidance, right, through that revenue procedure. And I'll leave that, if you click on this button right up here, you can watch that video. But basically what the IRS is saying is, if you plan to have your PPP loan forgiven, whether it's in 2020 or 2021, the related expenses you're using to have your PPP loan forgiven will not be tax deductible, right, for 2020. Once again, those PPP expenses you're planning to use to have your loan forgiven will not be deductible as a 2020 tax deduction, okay? So what we're recommending all of our clients to do, and for you, is to make that adjustment. Do not touch any of your expenses, right? But just make that adjustment on the income side. So let's go over a numerical example. Let's say you received a PPP loan for $20,000 in 2020, and you know that that $20,000 is going to be forgiven, right? You know, you used it, maybe used 100% of it for payroll, right? Or you used it 60% for payroll, 40% for rent, utilities, or mortgage interest. You know it's going to be forgiven, right? Once the banks start accepting forgiveness applications. So what you have to do for the 2020 year is you need to make that tax adjustment, right? If you've been doing your bookkeeping or tracking your expenses, what we do know is, you know, your payroll expenses that you're planning to have forgiven, as well as utilities, mortgage interest, rent, things like that, those are included in your income side, on your expense side, right, of your income statement. The tax adjustment that we're recommending for you to make is to just include that PPP loan of $20,000 in other income. Just label it as PPP loan, so that way the two will offset. So remember, you have 20, you're going to recapture basically $20,000 of income, and then the expenses you're going to use down here, payroll, rent, utilities, mortgage interest, you know, those are already in there, right? So they're going to offset each other. So 20,000 up here and 20,000 down here, well, those two should net each other out, right? So you have to make that tax adjustment before yen. Going into our number 2 thing that you must know is paying your quarterly estimated tax payment, right? The reason why the PPP loan adjustment is so important is when you make that Q4 estimated tax payment for federal and for state, for some of you, you have to include that PPP adjustment, okay? Sadly, what that's going to do, it's going to raise your taxable income, right? Because you don't get that offset for the payroll expenses, right? And PPP expenses on the expense side, right? Because we're adding back and doing that tax adjustment at the top, right? So make sure you include that in your quarterly estimated tax payment in Q4. Remember, the deadline for your Q4 quarterly estimated tax payment is coming up. It's January 15th, 2021. Okay, once again, the deadline is January 15th, 2021, which is only a few weeks away. And in the next part of the video, I'm going to talk about ways to lower that quarterly estimated tax payment or your taxable tax due for 2020. All right. Remember, you have to submit, or you should submit, definitely, a quarterly estimated tax payment so you avoid any penalties and interest related to late payment. Okay. All right. If this is the kind of content you're looking for, don't forget to hit the subscribe button and to turn on your notifications. All right. All right. So let's go over the top 3 ways to lower that taxable income for 2020. Okay. And there's even more reason to lower that taxable income for 2020 for all you business owners. And, you know, 2 of those reasons is, number 1, you know, that pending second stimulus check, right? We know that there are income limitations or qualifiers to be eligible for a stimulus payment. So it's even more reason to lower your taxable incomes to make sure that you qualify. Number two, state and local governments are continuing to push these government grants. Here in Illinois, you probably received notification of the business interruption grant. So if you're a business owner operating here in Illinois, that's where my firm is located, you probably have seen things for the BIG round number 2. If you haven't, check out my video up here for that, right? And you want to apply because those grants are still available. And remember, those grant limitations, not only the second stimulus payment, but the grant also have limitations and qualifiers, and it's usually based on income. So you don't want to miss on those. So let's go over how to lower your taxable income for 2020. The first strategy is to accelerate expenses or prepay expenses using either cash or credit card, right? Common expenses that you can prepay are actually things like equipment purchases, right? That you're going to be making or have to make in 2021, make them in 2020, right? Rent expense, right? Anything that you lease, whether it's a copy machine, whether it's your computer software, computer equipment, whether it's a car, a company car, whatever, or even just your normal rent expense, right? For your business, try to prepay. Talk to your landlord to see if you can prepay those expenses in 2020 instead of 2021. I'm sure they'll be more than welcome to take that prepayment. And if you don't have the cash available now, use your credit card, your business credit card, to make these prepayments. Maybe IT fees, right? Maybe you outsource your IT or information technology to a firm. See if you can prepay those expenses. And lastly, employee bonuses, year-end bonuses. Many companies actually issue those in January. If you want to lower your taxable income for 2020, then maybe think about prepaying your employee bonuses by December 31st, right? So remember, all of these expenses, as long as if you want to include them for the 2020 tax return and lower your taxable income, you need to have expensed or paid it out, right? Paid for that item or prepaid by December 31st. By December 31st, 2020, in order to include it in your 2020 tax return. All right, number 4, another way to lower your taxable income for 2020 is to slow down collections or receivables. Once again, slow down collections or receivables. And a really good way to do that is to actually slow down your invoicing process, right? If you haven't issued your Q4 invoices, or let's say your December, November, or October invoices to clients, if you want to lower that taxable income, one really good way is to wait to invoice them to the last week of the year or the last day of the year, right? Normally, we do our invoicing on December 1st here at our firm. What we could do potentially is to wait to invoice clients maybe by the last week of December or December 31st. So if you want to lower your taxable income, one really easy way to do it is delaying invoicing. Even collections, if you have clients that have not been paying your invoices in the past, maybe you can ease up on that collection process, right? And maybe reach back out to them that first week of January, right? Because what you gotta remember is, for tax purposes, especially if you're a cash basis taxpayer, cash basis means that you report only the income that you received and the expenses actually paid for, right, in the year in which that occurred, right? So what that means is if you delay collections or delay invoicing, you won't have to report that income until the year that you actually received that income, right, or that payment. And if you delay the invoicing and collections to the last week of December or December 31st, most likely those payments won't come in till January 2021. That means those income items will need to be reported in January or on the 2021 tax year. Once again, lowering your taxable income, because you have less income to report, more expenses, then you have less profit, right? Lowering your taxable income. Profit, taxable income kind of go hand in hand. All right. The last way, and the really most powerful way to really lower your taxable income for 2020 as a business owner, is to maximize tax-deferred retirement savings. Once again, maximize tax-deferred retirement savings. Very powerful vehicle. And there's two really common and really powerful ways. The first one is a SEP IRA. Okay, if you are a small business owner and maybe you have 1 or 2 employees, or you're the only employee on payroll, a SEP IRA is a powerful way to lower your taxable income. For 2020, the max SEP IRA contribution is $57,000. Once again, $57,000 is the max SEP IRA contribution you can contribute, okay, for the 2020 year. Remember, as long as the plan is open by December 31st, you can make that contribution next year in 2021, right? As long as you make it before your business tax return is due, which is probably going to be March 15th or April 15th, depending on your entity type. Just make that SEP contribution before then, but make sure you open up the SEP plan, right, by December 31st, just so that you can make that contribution sometime next year. Remember, you can lower your taxable income for your business by $57,000, up to $57,000 if you use a SEP IRA. Remember, the SEP IRA max contribution is based on compensation, your compensation as a business owner. And when I say compensation, I'm only talking about W-2 salary you take from the business, not your distributions, right? Not money that you just transfer over from your business checking to your personal account, but salary, W-2 salary. So you must be taking a salary from the business in order to qualify to make a contribution to the SEP IRA, okay? Remember, the max SEP IRA, it's going to be either $57,000 or the lower of the two, $57,000 or 25% of your salary that you're taking. So for example, let's say you are taking a salary of $100,000 for 2020. You're on track to take $100,000. The max SEP IRA contribution will be $25,000. Okay, 25% of your total salary taken from the business, right? You can't contribute the $57,000, unfortunately. It's going to be down to $25,000, okay, as a business owner. Remember, let's say you're a business owner and you haven't been taking a salary or a reasonable compensation during the year. Remember, especially this is important if you're an S-Corp shareholder, okay? If you're an S-Corp shareholder and you've not been taking a salary, that is a big red flag by the IRS. So make sure there's still time. There's a few weeks left for 2020. Make sure you take that salary and contribute to that SEP IRA if you haven't already, okay? And the next tax-deferred retirement savings vehicle that I definitely recommend for all you business owners out there to consider is a cash balance pension plan. Once again, a cash balance pension plan. Last year, we had a client that had a lot of excess cash left over, right, for the year, and they were looking at ways and how to save, and pay less in tax, but also save for retirement. We can recommend always the SEP IRA, but sometimes compensation levels, right, might not be there to maximize the $57,000 max contribution. So a cash balance pension plan is another great way. That client specifically was able to contribute over $100,000 for him and his spouse based on his compensation from the business last year in 2019, right? That saved him about $40,000 of taxes, right, that he didn't have to pay. Remember, with a cash balance pension plan, with a SEP IRA, with a lot of these retirement accounts, make sure you open up the retirement account before or by December 31st this year, right? You can always make the contribution for a lot of these retirement plans next year, right? It's almost like a little cheat there, right? You don't have to make the contribution by December 31st, but you can make it sometime in January, February, March, just as long as you make that contribution before your business tax return is due. That's usually the deadline. So with the SEP IRA, with the cash balance pension plan, you can always delay making the contribution, but don't wait to open up the account, okay? Remember, delay the contribution, but open the account early and within the 2020 tax year or calendar year. All right. Once again, if this is content that you're looking for, please don't forget to hit the subscribe button below and to turn on your notifications so you don't miss out on any great videos. Thanks for watching. Please leave any comments and I'll see you next time. Bye.